Welcome back. You're still tuned into Markets at Noon, and in the very first edition of ET Now Roundtable, we caught up with Citi India to decode India's path to a Vixit Bharat 2047, a transformative journey that will shape the nation's economic, social and geopolitical future. From sectoral opportunities to the engines that will power India's next phase of growth, Citi lays out its vision for the road ahead. Here's an excerpt from that exclusive conversation, and you can also catch the full discussion at 3:30 p.m. today.
I think durables is one space where we believe that the risk reward is very favorable. And if you look at the category, right, it is a category where the demand is non-perishable. So if someone who wanted to purchase a AC this year has not purchased it, it's not that the demand is lost, right? So it just get pushed next year. And we have seen this playing out with jewelry, when during COVID, a lot of marriage did not happen, and then you have seen a very big pent-up demand. I think durable also fit exactly in that place, that this year was a washout year given the early monsoon and a prolonged monsoon. We have not seen a second summer, which typically happen. And then there was a GST rate cut, which on a large ticket discretionary category have a big impact. So to that extent, I think risk reward is much favorable on the durable space.
In the paints business, we're seeing the leader now coming back aggressively into the market after last 6 quarters of hyper competition in the market. Do you see that the large players are now going for the market share and maintaining the market share at the cost of margins and profitability?
I think that's what the company has been communicating, that they want to now focus on market share, especially given that if you look at the raw material prices, it has been benign. So that's giving them some benefit in terms of passing on the discounting. But the competitive intensity remains elevated, especially if you look at the discounting, rebates, etc. That has actually increased over the last 1.5 to 2 years. And especially if you look at the new consolidation also which has happened, the competitive intensity is about to increase. So we think while the competitive intensity is here to stay, but yes, there could be some benefit because of soft RM prices.
Ashish, if I were to come to you on durables one more time, give us a sense on the pickup. Will it likely happen in Q3? Because it's generally a seasonally slightly more subdued quarter, even though you've got festive which comes through. But post-festive, it starts to get slightly more subdued. What's the sense there? Or do we wait for Q1 FY27, where we start to see the summer kick in and the summer sales start to come back? So at what point does that growth start to fill up, in your opinion, given everything that's played out in GST?
Sure. So see, 3Q will be slightly better versus what 1Q and 2Q has been, partly because of the GST rate cut benefit. Because if you see from 15th August to 22nd September, almost 5 weeks, there was almost very negligible sales. So 22nd September onward, you have seen some pickup. So because of just that deferred demand, some pent-up demand, you will see some pickup. But I think 4Q is going to be a much bigger quarter, and that has historically been the trend, because 4Q around Feb and March, the channel starts to build up inventory ahead of the summer season. So if you look at 4Q and 1Q, this 2 quarter almost accounts for 2/3 of your revenue. So I think 4Q would be a much bigger quarter where you see a much bigger benefit coming in.
So, IT, numbers were better than expected. Means we started the quarter on a very muted and we thought that it will be a bad quarter for IT, but many of them surprised because of currency depreciation as well. But do you see going into the second half of the year some kind of revival happening for IT, because we saw the IT index rebounding nearly 4% in November itself?
Yeah. So on IT, I think you will few things there. Firstly, you'll have to look at first quarter and second quarter together. Okay, what happened in the first quarter, the June quarter, was that the numbers came in lower than expectation, and expectations came down. Okay, so we went into September with a really low bar as far as expectations were concerned. And when you look at the numbers, they are slightly better than that. So if you look at the year-over-year numbers for, say, the top 10 companies in the sector, the growth rate YOY is still the same. It's approximately, give or take, 2% year-over-year. Okay, so the important point here is that we are still stuck in a low growth trajectory because of a bunch of reasons which we can discuss. And this is the third year of low growth. If you take our entire coverage, in FY24, growth was 2%. FY25, it was 4%. This year, it looks like another 2%. So the industry really needs to break out of this low growth and at least go back to 6-7% growth for any meaningful upside on the sector, which at this point of time we are not comfortable to call out. Okay, all the variables when we look at the US macro, we look at what's happening in the GCC space, we look at the AI productivity, which is an integral part of all deals. Still not comfortable to call out that kind of a recovery. We are building in some recovery next year, but not a strong recovery.
Are you building in also revenue deflation as well as AI comes into play?
Yeah. So that is a part of how we build in numbers. We really don't build it in explicitly, but increasingly when you talk to companies, it is a part of all new deals or renewals as and when they happen. Some of the companies have been calling it out very vocally. They are doing it proactively. They are going to their top customers and offering meaningful productivity or savings. So it is starting to happen and it will continue into next year. So all of these things, one needs to kind of think together. And if so I think compared to the current level, will things improve? Possibly they will, because we are at a really low level. This is like the third year of slow growth, which this industry has never gone through. Okay, but how fast is the recovery is important, and we are still expecting a moderate recovery.
And what will lead to this recovery?
So it's a bit of quite a few things coming together. One is clients generally around tariffs, etc. There was a lot of uncertainty. So there were cancellations, pauses, people really going slow for a few months. That ideally should not be the case next year, at least based on what we can see today. So that is the first thing which is in favor. Short cycle spending has been really muted for the last couple of years. So hopefully as things stabilize, a little bit of it comes back. Again, that's a starting point assumption that we are also building in. Okay, and third, we'll really need to see, but last few years, couple of years, incremental budgets have been almost entirely going into AI. Okay, now if that kind of starts normalizing a little bit, maybe there is a little bit more room to spend on other parts of technology services. I think all those things really need to come into play for the industry to see that growth acceleration, the growth pickup we are talking about. But I think the market expectations are much higher than what we think can happen. So which is why we are still cautious on the sector. Like one quarter here and there is fine. Okay, you will have quarters where things are a little better. I think the direction is more important. And that continues to remain quite muted. And the other thing we struggle with is when we look at US listed stocks in the same sector. Okay, the multiples are very, very different. Yeah. Okay, like names trade at between 10 and 13, 14 times earnings. Whereas in India, like stocks trade between whatever, 19 and 25, 30 times earnings, even 40 times earnings. So clearly the valuations are, and these are global businesses. So we understand the domestic mutual fund flow helping these stocks perspective. But how much of a valuation premium is always a subject of debate.
Rashi, let me come to you. Metals. We've seen a very good rally. Books look better in terms of the balance sheet strength, just looks much better towards a capex upcycle. How well are we placed? And what's your assessment of how the global pricing picture is playing out versus India?
Okay, so I'll just kind of break that up into ferrous and non-ferrous. Yes, now, when you talk about the balance sheet strength, right? So as far as the steel companies are concerned, the majority of them still be amongst the larger ones that we cover would still be in the 3.5 times debt to EBITDA, right? So obviously the context is what was around COVID, etc. The balance sheets are better. But we are also in a situation where steel realizations are weak today versus, where they were even in the last quarter. And, as we're seeing, this is the first time around in a long time in the last few years that steel prices are at a discount to import parity, assuming there's a safeguard duty, right? Like for the moment, like, that has to come back. And obviously there's a lot of supply that's kind of coming together, which is impacting realizations. So when we put all that together, I would imagine that the steel companies would be a little bit slower on their capex plans. Than because, we're already at 3.5 times, and we'll be talking about some of that going up now, in the coming quarter or so at least. And then we'll see, in terms of how the Chinese anti-involution works out, how India demand pans out versus supply and, things like that. So I would say that this will be a little bit of a slower move now. I mean, everyone's announced longer term plans, but how quickly they execute, I think, and Tata Steel has already mentioned this in their last call, that the execution will depend upon, demand profitability and things like that. So they're not speeding up the process of announcing dates yet.
So, when prices are soft, we are also seeing some of the Indian companies adding capacities as well, which is there. Do you think that that's going to put more pressure, given the fact that prices are still at a discount to import parity? And if the government does not extend those, there is room for price increase from here on?
I guess the reason that we are seeing this pricing pressure is because, too much supply came in together relative, to the context of the capacity, because the bulk of the supply is flat steel, right? And yes, flat steel is operating at like 90-95% before this capacity came in, but you're essentially, we have like a forecast starting from FY24, the next 4 or 5 years of about 35 million tons of supply coming through. And I would imagine that the majority of that would come by the close of this year. Obviously, it takes some time to ramp up, right? And this is all the larger players who are adding the capacity. So there is going to be some amount of pricing pressure, most definitely. Having said that, once the safeguard duties are back in place, and this whole system stabilizes in terms of the demand-supply balance, from a China perspective, from an import parity perspective, there's definite headroom for steel prices to move up. Now, whether that happens 6 months later, 3 months later, that's a question which is difficult to answer. But when you look at the equity valuations for most of these companies, if you take spot profitability, they're extremely stretched. But if you take that these steel prices will move up to import parity, assuming there's a safeguard duty, then these, the stocks are appear to be fairly priced. So I think the market is already pricing in some recovery in steel prices, but timing is uncertain.
What about non-ferrous?
So on the non-ferrous side, it's essentially, we're very bullish on aluminium as a commodity, but slightly longer term. In the sense, the aluminium outlook that our commodities team has is a very balanced market until calendar 26, and in 27 we're expecting a deficit. This is largely because there's no real supply growth vis-a-vis demand growth. China, I think the capacity cap appears to be reasonably serious. Against that backdrop, we obviously have plays like, Hindalco, Vedanta, etc. Now, for each of them, again, balance sheets by and large are now much better than they were, to answer your question. Especially for Vedanta, they've managed the balance sheet not only at their own level, but even at the parent level. Hindalco on a consolidated basis is a comfortable balance sheet. Novelis obviously is going through its, challenges at this point in time. So I'd say someone who has a slightly longer term view, on the commodity, for them, these are good places to be in. But in the very near term, there are smaller issues like the Trump tariff, the Novelis fire that they've had. They suddenly raised the capex. And then Vedanta, again, we're not really sure on what's happening on the demerger in terms of, timeline as well at the moment. But generally, purely as commodity plays for aluminium, these are in a good space.
Excellent. Kunal, let me come to you. ROA lift will be delayed even if it's 25 bips, or would you imagine that the ROAs will be more manageable and we've hit the bottom and now we will go up even if there is a 25 bip rate cut?
So that's very interesting question, and this has been debated all through 100 basis points of repo rate cut. But if you look at the stability of ROAs for most of the leading banks, in fact, all of them, they have been able to sustain the ROAs. So there are enough of levers which are available, be it in terms of operating efficiency, maybe credit cost. We are seeing like asset quality very much in favor of banks, very low credit cost which is coming in. So that has been able to offset any pressure on margins, and they have been able to sustain the ROAs even with 100 basis points of rate cut. So we believe like that might still continue even with 25 or 50 basis points of rate cut.
Kunal, one of the themes which has played out this year is public sector banks versus private sector banks, where PSUs have outperformed the private sector banks. What's your view on them?
Yeah, so when we look at it over last 3-6 months, in fact, PSUs have outperformed by 10 to 15% to Bank Nifty. And the key reasons for that have been, again, the sustainability of ROAs, which was the question. Third quarter, I think people always thought that with limited treasury gains, we would see ROAs coming off for PSU banks. But somehow, all the PSU banks, they were able to sustain ROAs about 1%. So firstly, in terms of the margin decline, that was not very high across all the banks. Asset quality, it was again very low credit cost, and growth, few of the banks have still been able to outperform the industry average.